statement is not designed to be all-inclusive of the inherent risks of trading in leveraged investments. Regarding risks, you should execute such transactions only if you clearly understand the nature of the contracts and contractual relationships into which you're entering and the extent of your exposure to risk. You are the only one who can determine and decide whether or not trading is appropriate for you, obviously considering your experience, objectives, financial resources, and other relevant circumstances. Trading is a speculative, high-risk activity that is challenging and not suitable for everyone. No individual advice nor trading management services of any kind are provided. Therefore, no listener, member, or subscriber should assume that their participation in the services this seminar provided herein serves or is suitable as a substitute for ongoing or customized individual personalized investment advice from an investment professional. I do not warrant that my products, services, or shared information will address, nor will they be suitable for all of your trading needs. Trades executed by listeners or subscribers are completed purely at their own risk. So just throwing that out there. Don't go trading on Monday morning, making the assumption that you know everything, that you're stock sensei. Usually I advise people to study the markets for a period of 3 to 6 months, even a year, paper trading, until you fully understand the dynamics of price action and momentum before going into trading in general with real hard cash. So here are two of my favorite quotes, one of them by Larry Hite and the other by Paul Samuelson. Larry says, I have two basic rules about winning in trading as well as in life. Sorry, one second here. I'm just going to move this screen over. There. Investing should be more like watching paint dry or watching grass grow. If you want the excitement, take $800 and go to Las Vegas. I don't 100% agree with that. I trade like I'm in Vegas, but usually I'm taking a gamble that's located. There's a difference between that and going to Vegas. Larry Hite's my favorite. I have two basic rules about winning in trading as well as in life. If you don't bet, you can't win. And if you lose all your chips, you can't bet. And I'm going to talk more about this later on when we talk about being a disciplined trader and monitoring your risk level and your commitment. So a bit of a background about the stock market. In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, silk, you name it, around the globe. And this was a massive operation. Obviously, it was capital intensive. It needed lots of money. So they reached out to a bunch of private citizens. And what happened was when they reached out, they offered them a share of the company, shares for the ship's profits. So if the ship was profitable, then they got a share of the profits. And they typically sold these in coffee houses and shipping ports. Surreptitiously, they had invented the first recorded stock market. That's the first documentation of the stock market. Obviously, there could have been other occurrences, but this was the first documented version of the stock market. And over time, the stock market has evolved into something much different than just selling shares to ships. The stock market today is considered as the collection of buyers and sellers of stocks and shares, or shares. I'll interchangeably here say stock, share, equity. I'm referring to the same thing for the purposes of this conversation. Shares represent, like Delapo was saying, an ownership claim in a business. So if I have a 20% claim on a business, I have 20% of the available shares. Can everyone hear me?
Yes.
I just saw some messages. Okay, perfect.
Okay.
Perfect. Shares represent an ownership claim in a business. It may be a security that's listed on a public stock exchange, or it's a private privately owned shares in the business for private companies, and it's usually sold to a group of investors, not the general public. And in general, there are different types of shares. There are common shares, there are preferred shares, there are many other types of Class A, Class B, different types of shares. For the most part today, I'm talking about retail investments. So I'm mostly referring to common shares, the shares that are available. And they would mostly be described as float. I'll describe that when you're looking through a stock. If you're trying to see how much of the common shares are available for purchase to the public, it's referred to as the share float. I'll show you how to find that. So today we look at the equity market as a loose connection or a loose network of transactions. Since the prior history of the stock market and until today, companies now raise funds from willing investors as opposed to just going to shopping, going to coffee shops or waiting at the shipping docks. The modern stock market has evolved. There are now changes in technology. You can trade stocks online as opposed to having to go to Wall Street. It's evolved as well with regulation. Jalapa was referring to his trades and going, and he was backpedaling in some of that conversation, and that's with regard to stock market regulation like insider trading. There's also insider selling. Insider trading could also be legal. It's not necessarily illegal, but that's a conversation for another day. So the stock market is a loose network of economic transactions, not necessarily a physical facility or a discrete entity. Investment in the stock market usually is done through a stock brokerage or an ETP, an electronic trading platform. So what happens? How do we end up having stocks? Usually what happens is, say I have an idea for a brilliant coffee company or a brilliant water bottle. All I do is I pursue my idea, and let's say I have this all built, and maybe I don't have the funds, because sometimes the entrepreneur has the funds, or the startup has the funds to proceed with the idea and just sell their product and make profit. Usually what happens is that if a new company launches on the market, the first thing they do is they advertise to big investors who get a first crack at investing. Then those investors typically, again, keyword there's typically, they would sponsor the initial public offering of the stock, also referred to as an IPO. The stock is then launched onto the broader market, so on the New York Stock Exchange or the TSX, the Toronto Stock Exchange, or the NASDAQ. Sometimes it could be an OTC stock. I usually don't trade OTC stocks. They're more risky and they have different tax implications. The stock is launched into the general market, and then people or companies who believe in the company. So say I see this stock about a bottle and I believe in that bottle. I go, well, you know what? I see it today. In 10 years, it's probably going to be worth a lot. So I go ahead and I buy it, and I hold my shares. So the moment I buy shares in the company, I have part ownership, some sort of ownership, a chunk in the company. And usually if there's good management, I'll talk about some of the factors that influence whether a company does well or is perceived to do well later on in this conversation. But with good management, usually a company becomes more profitable or shows potential or doesn't. And the forces of supply and demand then play a role in the share price. So I bought in this stock at $20, and a good example is Jumia. It was supposed to be the Amazon of Africa, the Amazon of Nigeria, and then there was an IPO, but there was an initial hype with the stock. It went, I think, from $9 to over $40 at some point, and it dropped drastically later on when there was more information in the market. So usually the forces of demand and supply. So I buy a stock at $100. If I find out that it's at $500, based off of my personal interest, if I want to sell that stock and someone else is interested in getting that stock, then they go ahead and they purchase it from me at a higher price, I'm out of that investment and they're in. So usually what I see the stock market as is just a location where people exchange investments. And usually once the original investors, based off of their risk tolerance, have sold their stocks, a whole bunch of market forces tend to play in general, like fluctuating price of materials, changes in production technology, costs of labor. Investors typically would concern themselves with, investors typically would concern themselves with the price of the materials, change in technology, labor costs, supply and demand for the stock, change in leadership. I don't know if anyone was watching APA Apache yesterday, but there was a huge spike in the stock price. And the reason for that was one of them was the potential agreement between Russia and Saudi Arabia and a whole bunch of OPEC companies to reduce oil production. So that definitely influenced oil stocks in general. But then a few hours later, there's an NR, there's a news release that the CEO of Apache was cutting down his compensation by 1 million. Usually when that happens, it tends to trigger some positive feedback in the market. There's a bit of a perception that the company is doing all it can to stay afloat in these dynamic times. So usually with good management, the company becomes more profitable, shows potential for profitability, like Tesla, for example. You saw the spike from around 290, 280 last year to over $800 this year. The reason for that was there was a news release that they were potentially going to meet their earnings goals for the first time in a really long time. So you saw that huge investor perception change. So the original investors then can sell their shares and at the new price, and these market factors tend to impact what happens. What other things that could influence the price of a stock is psychological factors. So I read a lot of books about psychology. I read about herd mentality. I read about riot mentality. I read about just market psychology in general. It does influence the share price. Sometimes there's really good news and you think, for example, cannabis stocks, people were waiting for the Senate to vote on the 420 bill in Canada, and most people were waiting on that to buy. But I was exiting at that point in time because I was thinking market psychology. Well, if people realize that, well, this is it, there are going to be a lot of people who are selling their stocks because the stock price is going to go up. So instead of doing what would be typical, I do the atypical and get out of that stock at that point in time, usually because I know, well, we're going to see a bit of a dip due to selling price action. So it's a decent idea to understand market psychology. So how does trading work in general? For me, I trade on two main things. I trade on news and volatility. I wake up at 4 o'clock in the morning. I read press releases. If there are quarterly earnings for a company, I usually look at them. Sometimes there's sympathy. There's relative action in a stock. So if you look at I want to say right around September last year, a lot of shippers were moving. There were a lot of Chinese shippers moving, like EARS, TOPS. That whole industry tends to see a movement if one big stock in that industry is moving. You see a stock like ACB, Aurora Cannabis, during the whole 420 bill rollout. You saw a huge spike before the vote in ACB stocks. And as a result of that, you saw a whole bunch of other stocks that were related to cannabis, like Tinley, TIN, that's the ticker, like CANN. A whole bunch of different tickers started moving because there's some sympathy movement relative to that industry. I also trade a lot based off of volatility. I buy stocks that are going to move. So I wake up very early in the morning, do a pre-market scan. I see what's potentially going to move. Where's the volume? And when I think about volume, I think about people who come to the markets to trade that day. What stocks are they looking at? Because if I can see where the numbers are at, I know there'll be a lot of volatility, both selling pressure and buying pressure, and it'll allow me to get in and make a decent profit before I get out. So I usually buy stocks that see large volume. Usually this is what it looks like for me. I have a bunch of screens just looking at this stuff. I apologize if I swear. I'm trying really hard not to. But usually what I look at is I don't know if you can see these bars. There are a bunch of green bars. That's a whole bunch of buying pressure. There are a bunch of red bars, selling pressure. So usually I look for when I see a bit of transition from selling to buying volume. I try to see who's in control, the sellers or the buyers. And I try to get in right after there's a huge sell pressure, because that guarantees the most profit. So why do most traders fail? I know you're probably contemplating that question. You're going, well, if it's that easy as just buying low and selling high, like they say in the movies, why don't people always just trade? Why doesn't everyone trade? Why do some people trade and not make profit? I know a lot of people who have gone into trading and they blew their account in a month, in a week sometimes. So why do they fail? Well, trading requires discipline. You need to make really good decisions. You need to be well composed, even under the stress of a losing position. You need skill and discipline, and I consider them as muscles that require experience to grow. A new trader's ability to make quick decisions and follow their trading rules will always improve with experience, but obviously that experience is built either by learning from a loss or learning from a profitable trade. And later on, I'm going to talk about documenting your trades, which I do for a single trade. The market tends to have a way of correcting a risky trader. I remember when I first started trading, I didn't know lots about trading. I was just jumping in and out based off of what my coworkers were saying around me, and I was very profitable. And then I was unprofitable with a bunch of trades, and I realized, oh shoot, I better go and learn this stuff and really understand what's happening in the markets. So the market has a way of giving you a stick after you take that big carrot, and you don't watch your risk. Trading is a lot of risk management. So like I said before, how do I find trades? I find trades by scanning the market. So I'm going to show you real quick here what I do. I've built some scanners. I've got this one's called Abe Quick Wins. Usually I want to look at what's happening extended hours, that's pre-market or post-market, and usually I just look for the change. I built this, so usually when you start, you would have to build your own scanners or buy some scanners. I have scanners for sale. And this is some shameless advertising. So I go in pre-market, and as simple as just clicking on a scanner that I've built, I can go in and I can see who the highest movers are in pre-market that day. So I can see, well, look at this guy's moving at 17%. Then I go and I start charting the stock. But I usually have a bunch of criteria that I set based off of what my risk tolerance is at that point in time. So I do some pre-market scanning, and I look out for where the volume's at, what the volatility might look like for the day. I decide what my entry and exit positions will be. I start thinking about the setups because I know that I'm not looking for 10 trades a day. It's not all about quantity. It's about the quality of a trade. You could have one trader who's making 10 trades a day and making $300-400, and I could make 2 or 3 trades and make $2,000, and I'm out of the market in an hour because I've spent the time to do the research. Most of the time actually executing trade might be in minutes. In minutes, you could be super profitable. You could opt your portfolio by 6-7%, which takes some brokerages for institutional investments. They probably take like a year to provide you 9%. The S&P 500 was constantly doing 9 to 11% annually over time. So what I do is I look for quality. I look for the perfect entry or the near perfect entry to get in. And usually in 10 minutes, I'm out of the trade. I reduce my exposure time in the markets, especially when I'm playing volatility. I don't want to be in there for so long. I get in. If it's not going well, I have a stop loss that gets me right out of the trade, and I'm looking for the next one. Like I said, it's educated gambling. I could lose 60% of the time and still be profitable because I'm going for quality trades. I look for supernovas. I've traded a few. I've traded some stocks that have gone from $2 to $35 in a day. And that does happen. And usually I'd follow my plan. I plan to trade and I trade the plan. Um, so that's how I find trades. What is my market strategy? Well, in general, I know Dolapo mentioned was talking about his trading pattern that would be considered fundamental trading. So that's like a Warren Buffett who would go in and see a stock that's at $2 or $3, and he goes, well, you know what? I have some faith in the company. I see the CEO. I see that they have good potentials. They have assets. There's a market for this, or there could be a market for this. Sometimes if you go and you look historically, say like in the 40s when the baby boomers were right after the war, you notice a lot of the companies that made it 10 years after that were companies that looked at, say, baby food, because you knew there were going to be a lot of kids. People just came back from war. The first thing they're doing is having supper with their wife and, making babies. So that's why they're called the baby boomers. So you have the baby boom, and if there's an investor who's thinking from a psychological standpoint and he's a fundamental long-term trader, they're probably thinking, what's going to happen in 10 years? Well, in 10 years, there's going to be the baby boomers, and they're going to need baby food. There's going to be baby clothing. And then in the next 10 years, what are they going to need? Well, there's going to be some sort of education. So education improved at that point in time. Education stocks, but not just education. Construction also moved a lot in the 60s and early 70s. And then 1 year after that, what's going to move? Well, 10 years after that, well, these guys are starting to make a little more money. At that time, they're starting to get settled. Maybe they're starting to get sports cars. So what was released? Go look out there. They had the Mustang, right? Was starting to get released. So you see different types of stocks from a fundamental standpoint. I'm not a fundamental trader. Some of the stocks I trade, I don't even know what they do. I go in, I look at previous chart history, and I think about what future chart history might be. I see volume, I see volatility. I'm like a vulture. I get in on the trade, I get profitable, and I'm out of there. I don't care if they're profitable 10 years from now. I care if someone is dumb enough to spend $10 on the stock that is worth $2 at this point in time. And if I can get in at 2 and sell at 10, I'm fine with that. So what I typically look at is I look at patterns. I look at resistance and support, and think of resistance and support like demand and supply. I look at those chart patterns. I look at catalysts in the market, and I'll talk about that later on. And institutional control versus retail interest. This is more related to high frequency trading. Usually when I go out and I try to snipe stocks, one of my buddies calls me the stock sniper. When I go to snipe my stocks, I'm usually looking for stocks with high retail interest and low institutional investing. So when you think about it, think about, say, CIBC. CIBC probably has a wealth fund management where they look after a whole bunch of clients, and they have institutional money. They have a lot of money to throw on a stock, and usually they use algo high frequency trades, HFTs. If you ever see that, it's reasonably algorithms that they've developed to help them get profitable on trades. And every trader needs to know when this stock is moved by institutional interest or it's controlled by retail interest. Because if I know that there's institutional control, these patterns won't work. I'm playing, it's kind of like playing chess against a computer. You most likely will lose. I'm not trying to come in here to donate my money into the market. I'm here to win. And that's what I'm going to do. I'm going to look for where all the retail volume is on the market in the morning, and that's where I'm going to go. Lastly, I look for solid risk management. Usually before I get into a trade, I determine if it's a good trade for me. I look at where the stock's currently at, where the stock can go to in the positive, where it can go to in the negative. And I usually go for a 1-to-3 ratio. I try to see if I can make $3 on this stock or lose $1. So for every dollar I might lose on this stock, I want to make sure I'm able to make $3 potentially. So that's my risk reward. Obviously, sometimes I get greedy and I go on a 1-to-2 type trade. but my risk management is set. And the moment I'm profitable, I'm setting a trailing stop. And that trailing stop, what it does is, if as my profits keep increasing, the moment that stock turns, it sells for me based off of my set risk strategy. I don't just jump in a trade because everyone on Stock Twits is saying they're going to get on that trade. I jump in a trade because I know my risk. I know exactly where I'm going to enter this trade. I know exactly where I'm going to exit. Sometimes I exit a few cents before, and I get in, I get out before everyone starts selling. And that's how to stay profitable. So I usually trade based off of price action. Price action is usually plotted on the chart, and you've probably seen this chart I threw over there. So this is showing price action, and if you look at my timeline, I'm actually looking at the stock market to the minute. I wish I could look to the second, but I'm not willing. I'm not that aggressive a trader. So I can see what's happening per minute. I can look at the 5-year history of this stock, and I can see, well, you know what? They've been at $100 and they're currently at $18. Yeah, maybe this is a good stock to buy with good news. I know that even if I lose money, I will come back in the future and get back in and make some profit. So I usually trade based off of candlestick charts. I look at the 1-minute timeline, I look at the 5-minute timeline, and usually this gives me the information I need from a pattern trading standpoint. I try to understand market sentiment. So if you look at, second here. So if you look at these guys, just put in a bunch of candlestick patterns. I'm just going to do a quick demo of what candlesticks are. I have a trading course, so if you're interested in way more details, feel free to contact me. I'll put up my contact information at the end of the presentation as well. But you can look at 2 main types of candlesticks. You'll see a green candlestick. You'll see a red candlestick. Usually the stock opens right there at the bottom. For a red candlestick, it opens at the top. What this means is the stock opened at a low price and it closed at a high price. But during that time frame, so this could be 1 minute, this could be 5 minutes, this could be this could be a week, this could be a month. That's what the candle represents. It opens at a price, it closes at a different price, and throughout that time period, it may have gone to a high, it may have gone to a low, but really I'm looking at the open and I'm looking at the close. If you look at this bearish candlestick, so bearish meaning there's selling action. Sellers are in control, it's in bear control. It opens at a higher price, it closes at a lower price than when it opens, and that's why it's red. It means there's a lot of selling. And there's the wick here is called an upper shadow, and the wick at the bottom is called a lower shadow. And these are a bunch of candlestick patterns that I usually try to look for. So if you want to learn about trading and you don't want to buy my course, what I would do is I would write down candlesticks, because you need to go and read about candlesticks. It's important to understand that if you want to day trade. So like I said before, fundamental trading, looking into the future, holding longer term trades. I hold trades for minutes, and if I have a lot of confidence, maybe I'll hold it overnight, maybe a couple days, if it's still very profitable. But usually I just do technical analysis. So if you look at that chart again, I have a bunch of technical indicators over there. There are a lot of technical indicators on my chart. I try to minimize them. I try to go naked charts for the most part. So I'm looking at, these are things that you should probably be writing down as well for different types of indicators you might want to go research if you're not looking to pay to learn. The relative strength index of a stock is good to know about. Bollinger Bands, some people use moving averages. You could use a 30-day moving average. You could use a 50-day moving average. You could use a 200 moving average. A lot of people look at moving averages. There are different types of moving averages. There are exponential moving average. There are simple moving averages. There's the moving average convergence divergence. People call it the MACD. People look at the crossovers. So say a lower moving average, like a 50-day moving average. So if I show you this guy, for example, on this stock, I'd probably go to 5 days there. So on my chart, let's not do that. On my chart, I have over here, the yellow is my 50-day moving average, and the red is my 200 moving average. A crossover is when I have the yellow line cross the red line, so a lower moving average has just crossed a higher moving average. That's usually an indicator of a potential bull run. So usually it's positive market perception at that point in time, and that's what you saw right after that cross. You started seeing some positive movement. So I look at that. I also look at the Ichimoku cloud. It's my favorite indicator to use. It's a Japanese indicator. It takes the 9, 26, 52 moving averages, and then it makes a cloud as well. But again, I cover this in my course, but feel free to read more about this if you want to learn about the Ichimoku cloud. It's a very important indicator. Usually it's telling you a story about price action and momentum. It's telling you if you are below the cloud, you're probably bearish, which is happening over here. Over here, when we're below the cloud, so this is a cloud right there. If I'm below that cloud, I'm probably bearish. I'm not seeing a positive move or trend. If I'm above the cloud, so not sure, I'm gonna turn off an indicator here for you. Let's turn off the Bollinger Bands. So if you see the clouds, if I'm below, I'm bearish. If I'm above, like over here, for example, there's a cloud over here and price action is above the cloud, then I'm probably bullish on that run. So those are some things I take into consideration. Let's put that back on. Don't want to have to struggle later on. I look at volume spikes. Usually when I wake up, one of the things I look for is who has the most volume, who has the highest price movement or price action over the day. And there are some traders who do a lot of counter trend trading. I don't do that. I quite frankly don't think it's worth it. But whatever works for you, at the end of the day, it's what works for you, what you're comfortable with. Once you understand your trading strategy and your plan and you've developed it, as long as you can stick to that plan, you'd probably be profitable. So supply and demand, resistance, support, I'll show that on a map here shortly. I look at gappers. So in the morning, a gap usually is when I have a few candlesticks and say price is at $2 at the end of the previous day, and it opens at like $6 the next day. That tells a story as well. It shows you that there's a lot of demand for that stock. And so usually when I play gappers, I try to play the first or the second pullback in the morning. I actually played that a lot on APA, for example. This was my trade on Friday. So you're getting a live information. Everything in this shaded area here, the highlighted area, that's pre-market. That's before the market opens. I didn't trade this. One of my buddies, he's actually on the call, had highlighted this stock as a good stock to trade. And I wasn't quite interested because I was looking at some other stuff, but he sounded very convicted in this stock. So I kept watching it, and I watched for the first pullback in the stock. And I wasn't quite comfortable getting in yet, and I got in on the second pullback. So usually a stock is making a positive move in the morning, pre-market, and then it pulls back. So price is now $4.92 from $5. And I'm thinking, should I get in at $4.92 or not? And I'm like, oh no, maybe I'll wait, because this previous level of resistance was held for a really long time, and it's become a level of support now. So I go to that price point, and I got in over at 463. I got out at the first huge red candle over there, and the reason I got out was, again, it's a previous line of resistance, so I know there will be some selling. I sold at that price point, 493. I made a few cents. Usually if I'm throwing in $5 in the market, this is decent profit for just one trade over 1, 2, 3, 4, 5 minutes. And then I got back in at that same resistance point, and I followed it all the way. If you notice, I was charting the whole time through. So this is what we would call an ascending triangle. Feel free to write that down and research it on your own. But I followed my ascending triangle, and I waited until it broke that pattern, and I got out of there. But I went in at 460. I was out of the stock at 529. I had a decent amount of shares. It was very profitable. So that's the ascending triangle. I mentioned that in my beginner course as well. So pattern trading, like I mentioned before, retail versus versus high frequency trading. When algorithms are trading against you, probably not a good idea. I usually go for stocks that have high relative retail volume. I reduce buying at the breakout. So I'll talk about a breakout later on, but I try not to buy stocks when they just break out from a previous line of resistance right away. So like this stock, for example, I was going to talk about it later, but I might as well just talk about it now. So this stock, if you notice, it was trying. So I might as well also talk about resistance and support. So what resistance is it's a point where a lot of people sell their stocks in the most fundamental sense. And support is a point where a lot of people have confidence at that price for the stock that they buy in at that point. So when I usually think about resistance and support, I was talking to my buddy the other day, and I said, my trading method is more, I don't look at resistance and support as price points. Yes, they are from a technical standpoint. I look at resistance and support as areas where there are people waiting to either buy the stock, that would be at a support, or there are people who are waiting to sell the stock. So usually, if you look at this, I'll go historically, you can see this price point on its way down. This stock held that price of 460 a few times. And usually when I look at resistance and support, I look at a longer timeline, like a 1 hour. If you notice, I got lots of lines in here. I've charted this stock before I got in. I spend my time charting and watching. I'm a vulture. I'm just waiting for it to be dead. And I write in and eat the carcass. So if you look at the stock, for example, I've marked $4 and $4.52 as well as $4.80 as good locations to get in and buy this stock. Obviously, I would have stop losses as well. So that morning when I saw this stock moving, I knew for a fact that, well, it's coming down. It's probably going to come down to that price. And I actually alerted. I said, this is a good price to enter. I also have text alerts for when I go into stocks for a fee as well. I stream my trades live as well. So if you're interested, hit me up. You can watch me trade live, obviously. So if you look over here, I've charted that price point. It held this point for 60 a few times in the past. On the way down, if a stock holds a price for a decent amount of time, and it does that a few times, that point is called a resistance point. That's a point where there's a lot of demand for the stock. So resistance is the same as demand. And support, so on the way up, support is equivalent to demand. And on its way up over here, you notice it tried to break 492, didn't. Came here, tried to break 492, it didn't. Went back down, tried to break 492, it was 494, it tried, it was a fake out breakout, it didn't. So now you know what a breakout is. A breakout is when a stock is trying to go past a previously held point of resistance. So here at the bottom, that's support, and here at the top, that's resistance. It's resisting the price action at that point in time. So usually I chart all of these guys and I go in and I'm looking for, I try not to buy when I reduce the amount of times I buy when I'm going into a breakout. So if you notice on this stock, I got in at 460, and that's why I stayed in this stock when it broke out from that price level. And the reason for that is I'm not trying to take a risk. If you notice, there's a red candle here. a big red candle here when it tried to break that resistance point. That's scary when you're trading live, because it could be a dump all the way back to the previous point and you just lost profits. And that's why I have a trailing stop to get me out of that trade as soon as possible. But usually I try not to get entries close to breakouts. I do sometimes when I have confidence in that breakout point, but I need to be statistically sure for the most part that I can be profitable going in at that breakout. And usually what determines that is my risk management. Can I get in here? So in here, I might have traded it. I knew there was a better entry, so I got in earlier. But I might have traded it because from 480 down to 460, that's just about 20 cents. But from 480 all the way to 536, that's way more than 3-to-1 odds. So I know for sure this would have been a breakout I could have played. Moving right on. So I tried to reduce my buying at the breakout, like I said, but if I would buy at the first and second pullback. Pattern trading doesn't work on all stocks, like I mentioned, so I stay away from institutional stocks that have a lot of institutional activity. And if you go online and you type institutional stock activity, you'll be able to see what the institutions are buying for the most part. Reversal patterns. I usually look for a clear confirmation of reversal before I short a stock. Sometimes I would play a stock on the way up and on the way down as well. So on the way up, I buy the stock. On the way down, I would short the stock. And for people who are new to trading, when you buy a stock, you're saying, this stock is probably at $2. I think it's going to get to $10. So you're buying that stock with confidence that it's going to go up, with some level of confidence. When you short a stock, as opposed to going long, so sometimes you'll hear for buying or being bullish, you'll hear long on the trade. On the other hand, it would be going short on the trade. What you're really saying is that I know there are a lot of people who think this stock is at $10 right now, but I believe it's not worth $10 and it's going down to $2. So what you do is you buy that stock from someone who has it, or you borrow, it's called. You borrow the stock from your broker at $10, you sell it at $10, and you wait till it gets to that point you think it's going to get to, and then you sell it, and then you buy some more of the stock at that new price of $2 and return it to the broker and pay him a bit of a fee, or her a fee, pay the broker a fee. So when I'm going long, or when I'm longing a stock, I buy it at the low price, I sell at a high price. When I short a stock, I buy at a high price and I'm betting that it's going to go lower. So sometimes you'll hear about hovering shorts. That's when you have a whole bunch of people who have shorted the market. They bought high and they sold at that higher price, and they're waiting for the stock to go lower. But instead of the stock going lower, and a typical stock that tends to squeeze shorters is Tesla, because Elon Musk has a loud mouth and he goes and he says that he's found private funding to buy out all the common shares, and people are like, oh, this stock's going to be worth a lot. So people are buying that stock. So all the people who have shorted that stock at that price are going to be trying to cover stocks, because the lower the price goes, the more money they're losing at that point in time. And they can't buy enough of the shares to cover what they sold at that higher price. Anyways, I talk more about this in my beginner course. So yeah, I like to set stops. I set my stops. So a stop usually gets you out of the trade if it doesn't turn profitable. I set it based off of my 5-minute charts. Usually stocks trend down with bad news. Sometimes bad news is good news, depending on momentum. And I have a bunch of slides where I talk about my philosophy for trading. I wrote a whole bunch of that stuff down just to remind myself about how I should be my own sensei sometimes and get out of things when I should. So stocks will trend with the overall market. Jalapo was talking about the New York or ARCA, ARCA, or NYSE. Some people, when you look at stocks, most stocks in the S&P probably trend in the same direction as the overall market in general, unless they don't have a reason to. For example, I work for a pipeline company, but so I'm not going to use that as an example. But you've seen Apache that I've given you here as an example. The overall market is tanking right now. The overall market, we've had a few green days of recovery, but I have my own opinion on that as well. So feel free to reach out, and for price, I'll tell you what my thoughts are and whether we're fully back in recovery mode or not. But the S&P is on its way down at this point in time. But on the other hand, Apache, it's on its way up. That's because it doesn't have a reason to go down, because there's some positive news. Now, the question is, how long will it continue that trend? So usually if I'm trading a stock that's within a broader market and that market is doing bad, but that stock is doing good, I try not to stay too long. I reduce my exposure time in that trade, because I know that the overall market is doing the opposite. And I don't want to get caught if this stock doesn't fully recover and follows the overall market. So usually there are catalysts, like I mentioned before, earnings. So I give you an example with Tesla. They announced potentially getting to good earnings. Now with coronavirus, they might not hit those earnings. So you're starting to see it turn again in the negative direction. News, good news. I trade a lot of biotech stocks, even before coronavirus. So I tend to have a decent idea of how the market works. I actually have a bunch of hot keywords that I search. So if we could please mute our mics.
Now you got.
Are you able to mute everyone, Jen? Okay, yeah, perfect. Thank you. I usually have a lot of hot keywords that I look at. So I have a news streamer and I go in and search for these hot keywords. These are my hot keywords for bio stocks. So biotechnology stocks. You probably heard of a bunch of names like CRC. You've probably seen a bunch of stocks that move just based off of coronavirus news. So if a company comes out and says, oh, we're going to phase 2 testing, or we got FDA approval. So I usually search for all these keywords in press releases, or we have a drug now for coronavirus and there are drug trials. Well, you know what I'm doing? I'm going to go long on that stock, because at this point in time, that's what's happening in the world, and people know that this will make them profits. Or you hear stuff like merger. So last year there was a lot of news about Mega Energy buyout or merger. There was also news of CEI, for example, potentially going into getting bought out. So usually when I see merger or I see acquisition, I try to look for the acquisition price, because usually stocks are going to trend in that direction. And then sometimes there are some activist investors. There are a lot of activist investors that go along against Elon Musk. And I usually read lots of platforms about news of what activist investors are doing. If you find a stock, there's a stock I really liked. Well, didn't really like. I liked a little. TOPS. This stock had some good news. It looked like it was going to move. It was over at 57 cents when the whole market tanked. And there was some news. It had come up this day. I actually traded at 20 cents at some point. It had come up. Yeah, this must have been my entry there, 20 cents. And then I was out at 22 cents. Usually with this, I think I had about 25,000 shares of this. So decently profitable. But you see the stock making a positive move with good news in pre-market, and a whole bunch of activist investors just come in and they're like, screw this stock, we're going to move it. And so you'll hear stuff like pump and dump. Be careful not to be held in a pump and dump. Sometimes you'll hear of market halts. So usually there are people in the market called market makers. They are actually there to make sure a stock doesn't make a huge leap unless there is substantial news. if there is substantial news and the company has not released it, then and the stock moves really high, really that usually that's an indication of some insider trading going on. So what's going to happen is the market makers typically halt that stock. So if you notice this stock, for example, this stock was at 26 cents and dropped all the way to 23 cents. In that time frame, it would have been halted because it moved over 13%. So another thing to read on is market halts. So retail versus institutional.
Sorry, just a note on the time. I'll say we probably have about 5 more minutes before we can go on to Q&A.
Okay, sounds good. Retail versus institutional traders, like I talked about, you and me were retail traders, either trading regularly or part-time or full-time. There are institutional traders who represent the larger market. Usually they have lots of capital, they're extremely aggressive, they have bigger positions, and I try to stay on the good side of institutions if I'm ever in an institutional trade. So you've probably asked, what do? I'm not a fundamental investor. I am an equities day trader. I trade only stocks in the American markets, the New York and the NASDAQ. I do not trade OTC stocks. I do not trade the Toronto Stock Exchange. I don't have a lot of faith in the volume there. I have a lot of faith in the Canadian-ness of the TSX, and I'll cheer you guys on if you're trading the TSX. It's an amazing market to trade into and right now. Make sure you trade in Canada, but I do all my trading in the US. I also keep all my cash in American dollars. So there you go. So what does a day in my life look like? I usually wake up at 4 o'clock, and 4 o'clock, when this should say EST. Nope, this should say MST. So usually when I wake up at 4, I do a bit of reading, and yeah, it's boring stuff. But I read a lot about psychology and market action and news and artificial intelligence. Yeah, that's what I like. But I like to trade pre-market. Pre-market trading usually starts around 8 o'clock to 9:20, and then the market opens around 9:30. And by 9:30, I mean Eastern time, so Toronto time. In Calgary, that would be 7:30. So I wake up, and around 6 a.m. when I'm seated, I'm at my desk at 6 a.m. I start finding stocks to play. I create a daily watch list. And then at 7 a.m., I have my coffee there. I'm ready to trade if I didn't already jump in and pre-market. So like I gave you that example with APA, for example. If I was trading this, I would have jumped in and pre-market. If I had a lot of faith in it, I would have got in at $5. $5 is, I know it's probably going to hold $5. $5 is one of the strong lines of resistance in penny stocks. So I'd probably, so I jump in and pre-market. If I didn't, then usually I follow the aggressive momentum gap reversal trades at 7:30 to around 10 a.m. Mountain Standard Time. So that's lunchtime in New York. That's when a lot of the people on Wall Street tend to go for lunch. So volume usually drops, and they're riskier trades at that point in time. I try not to go in. People who usually trade around lunch hours are people who probably lost money anyways in the morning, and I'm not trying to be a fucking loser. Oh, there we go. I swore. I tried. So usually 10 a.m. to 3 p.m. there's light trading. People who are still trading at that point in time are probably trying to recover. I trade 3 p.m. to 4 p.m. sometimes. It's power hour. So if you've ever heard of power hour, the most volume in the markets usually happen around 10 o'clock to 11 in the morning, and 3 to 4 in the afternoon. And again, that is Toronto time or New York time. So for me, that would be 8 to 9 would be my momentum moves in the morning, and it would be 1 to 2 in Calgary time. So that's a day in my life trading. Technology, what's important to have when you're a day trader? A computer. You need a decent computer. You need good ergonomics. I'm very comfortable in my chair. I can sit here as long as I can, And sometimes my employer lets me trade at work. Sometimes. Um, if I do, then I'll probably spend like 30 minutes trading at work and then spend a lot more time after work getting work done. But you need a good computer, you need a good CPU, you need a good graphics processing unit. It's very important. You need a few screens. Like I mentioned, I like to look at the 1 minute and the 5 minutes. So I don't like anything distracting my trading screens. I need to always to keep my eyes on the prize and know my entries. Sometimes I also set alerts when the price is coming towards my predetermined entry. You need a few screens. You need a good keyboard and mouse, and people need an ergonomic keyboard or ergonomic mouse, obviously. Usually, I use TAS. Some people say TAS. It's a market indicator. It's used by over 15,000 trades on Bloomberg terminals. So usually I know what the high frequency traders are doing. I know what hedge funds are doing. I like indicators. I usually use the 50 and the 200 SMAs, the simple moving averages, as well as the Ichimoku. Obviously, in the morning, the first thing I do once I pick a trade is I draw all the lines of resistance historically, and I know where my entries and my exits potentially could be. My broker is TD EasyWeb, the web broker. In the past, I've used Qtrade, I've used Questrade, but I like to use TD. This week, they almost lost me some money because it glitched out, but luckily I had a trailing stop that worked, so that was good. How do I scan the market? Well, like I mentioned, I have my trading view scanner over there. So I scan over here. I can scan for headlines on any stock I'm looking at. I have stock twits live there as well, so I can see all the chats by people who are following the stock. I can see live price action. I can see RSIs and a whole bunch of the good stuff. MACD. I have a Squawk Box, Benzinga Pro subscription. That's where I listen. It's kind of like a radio for the stock market. It's kind of cool. I can hear what everyone's saying about stocks that I'm looking at, and I also have hotkeys in the level 2, so that lets me get in and out real quick on stocks that I'm looking at. So that's technology. Risk management, like I mentioned, the ebb and flow of the market. I follow micro channels. I maintain, so you might want to write that. Macro channels. That's something you might want to learn about. I maintain my strategy. I have a written strategy and I follow it. And usually when I don't follow my strategy, I'm not as comfortable in trades. I try not to be impulsive. If I sit there, I wait until I get the right trade, then I get right in. And once I get to my price point, I'm out. I always like to ask people that question: is this trade worth it? When people ask me, what do you think about this? I'm like, oh, well, what do you think about it? Is it worth it? And I always record and I review all my trades. So this is, 1 second there. So here's an example of, I record all my trades. This is 2018. So I record my trades. Profit to date, every day I go in. Sometimes I even convert to Naira for the Nigerians on here to see how much I made. And then later on, when I started trading multiple, when I had more screens and I started trading multiple trades, I try to document what my entry is, what my exit is, what my capital is that I went in at. Sometimes I even write what I'm thinking before I go into the trade. These are my thought processes, kind of like a diary of my trades. I keep track of that. Let's do that. So I encourage people, if you're trading, make sure to record and review every trade. So at the end of the day, what do I do when I get home from work? I sit at my desk at home and I review every single trade that's profitable. I don't like anything to be serendipitous. I don't like anything to be, oh, I was just luck. I make sure that there was a method to my madness. And if there wasn't, I remind myself, hey, Abe, you shouldn't trade that way. You should watch your risk. So that's what I do in the evenings. I review my trades and then I pre-scan what the gainers that day are and what the main losers are, because usually that will get a lot of news and they could move the following day. What else do? I in the past I read some Richard Kiyosaki, and he advocates lots about financial literacy. Um, I try as much as possible to provide education, if I can, about financial literacy for a fee. I do a bunch of business optimization. So if you got a business and you're looking to optimize, you're looking to grow, I'm your guy. I know a little or a little or a little more than a little about contracts and how to get into different businesses, get your foot in the door, kind of thing. I advise individuals. I'm not legally allowed to use the word advising, so I'll take that back. I help individuals prioritize their debt and how to utilize debt instruments in the market. There are lots of debt instruments that help you use the bank's money. If you read lots of Richard Kiyosaki, he talks about making money work for you and whatnot. I make my money work for me, and sometimes I use the bank's money and make it work for me as well. So I advise on that as well. And yeah, here's my contact information. Just as I close, feel free to hit me up if you're looking to learn some more. Usually there's a fee, so.
Abraham, can you also share that in the chat as well, just so that people can copy that in case they don't, in case
sure.
you stop sharing your screen. Yeah.
Sure, I can do that. And just a bunch of, I'm done, but I'm just gonna give you guys a bunch of ideas here, my thoughts, this is my trading strategy. This is what I try. This is my mantra. This is what I try to tell myself for people who believe in positive affirmations. I tell myself, maximize wins, minimize losses. I talked about being profitable even after losing 60% of my trades. If I lose 60% of my trades, as long as I maximize my wins, if my wins are bigger and my losses are smaller, I'm always going to be profitable. Making money is more important than being right. So I've shown you a bunch of charts. There are also some charts where I said this trade is going to be good. It's going to be the best fucking trade ever. I tell some of my buddies, I'm like, this is it. And then I get in the trade and it's not going in the direction that I said be in. I'm out of that trade. The moment it's not going in my direction, I'm out, and I'll wait for a new entry and get back in, because making money is more important than being right. There are a lot of traders who they're losing, but they're like, oh, I know, God is on my side. No, the market's not on your side. The market can stay wrong long enough, then you can stay solvent. Be willing to change sides if the market is telling you to do so. So my question to myself is the market telling me to stay in or to get out? And usually if it's saying get out, I'm out. Charts are a picture of where traders are lining up to buy and sell. So when I was talking about resistance and support, usually if I know that this is a previous line of resistance, I'm not waiting to get to that price to sell. I know there are people lining up to buy and sell. So before we get to that price, I've sold, or at least I've set a trailing stop. In this case, I set a trailing stop and I didn't sell because I know that I'm in an ascending trend. I've already charted my ascending triangle there. Plan to trade and trade the plan. Don't change your plans because you think that you're just lucky today. The market's going to teach you. Maintain your strategy. Don't get trigger shy. So again, back to what I said about being 60%. Sometimes you could lose 60% and still be profitable. The thing with a lot of traders and why they blow their accounts is they lose, and maybe say they lose 4 trades in a row. Then they change their strategy mid-trade and they keep losing. The truth is, if you're losing and you know that your strategy is legit, as long as you stay in that trade, statistically, you're likely to be profitable as long as you keep those losses low. Use naked charts. I obviously don't do a lot of that, but I do for the most part. Most of the stuff you'll see on my charts are just resistance and support lines, and usually patterns when I start seeing them form. Like here, I'm starting to see a squeeze, so then I get in and I hold and wait. Being uncomfortable trading is okay. Shoot for calm in the storm. Be comfortable being uncomfortable is usually what I tell myself. The market is your workplace. Be a participant, not an onlooker. I know a lot of people who start trading, then they lose and they want to be onlookers. But at that point, you've taken a loss. Why don't you try to follow your strategy the whole way and get in a successful trade? Because at that point where you say, oh, I'm out, and then you realize, oh, shoot, I should have got an entry there. I had a resistance line there. I should have got in there, or a support line. Well, too bad. The market's not going to wait for you. There are millions of people trying to trade. Quit trying to pick tops and bottoms. So in trades, I don't necessarily, like here on this trade, I don't need to get all the way to the bottom. If I know that my risk is all the way to the top here, my reward, and my risk is only this much, I don't mind getting in a trade over here for a few cents, knowing what my profit margin is. I'll get in at the right time and set my stop loss so that if it doesn't go in my direction and goes in the opposite direction, yeah, I take a $200 loss or $100 loss, and I wait for the next trade to execute it properly. No stock is cheap or expensive. Some people say, oh, I only trade penny stocks. Oh, I can't trade Tesla. It's already at 300 bucks. Well, it could make 800. As long as the stochastics and the fundamentals and technical analysis is telling you this is profitable, it is profitable, and there are people looking. Buy higher highs and sell lower lows. I talk about this in my course, but feel free to reach out. I'm not going to explain that in too much detail here. Trade aggressively when trading well, and modestly when you're not. If I ask a lot of people, how much do you put in on every trade? And they just tell me, oh, I always have 10 grand every trade. Well, that's a bad idea, because that's how you blow your account. Usually what I do is I trade aggressively. If I'm being very profitable, like if I look over here and I know I'm being very profitable, I'm willing to stay longer in this trade as I'm in an uptrend. So I'm willing to hold and wait. I can be more aggressive on this trade because I'm profitable. So I trade more aggressively when trading well and modestly when I'm not. So if I'm going in 10,000 shares, it means, oh, I've been trading really well and this is a good stock. The risk agrees with me. So I'm going to go in with a lot more money on this trade based off of statistics in my history. The market will be open again tomorrow. There's some people who have quick fingers. They're like, oh, that's a good stock. Yeah, let's get in. Oh, that's good. Let's get in. The market will be open again. If you're not profitable today, review your trades, understand why you are not profitable, and try again tomorrow. Don't be a donor. That's what I tell a lot of my students. You should not be a donor in the market. There are lots of people like me and other people in the market who are waiting for your free donation. So if you're willing, sure, I appreciate it. But the market will be open again tomorrow. Never add to a losing trade. I've talked to some people and they go, well, the stock was $4 and I got in and I was hoping it would get to $6, but now it's $3.50 and I know it will turn at $3. So I'll just wait for $3 and put some more money in and I won't get out of this trade. That's a bad idea. Averaging down only ends up hurting you in the long run. If a stock is not profitable, there are thousands of other stocks to trade in the market. Look for those other 3,000 stocks out there and trade them if they're going to be profitable. If you take a loss, I'll happily take my L. Hand it to me, NASDAQ, I'll take my L and I'll drink my nice rum and I'll continue. Cash is the goal, but it's never the measure of success.
Sorry, Abraham. We're way past our time, so I'm actually just gonna say that we should probably jump right into Q&A because there's a bunch of questions that have already come in.
Okay.
And I just want us to be able to go through most of them. And Dolapo, feel free to unmute yourself because I've seen some questions here for you as well. So this Q&A session is going to be for both both presenters. So the first question we have here for Abraham, this is a quick one, is how much do you charge for your classes?
Contact me on Instagram. I will put that information up there again, and I will provide that.
Okay.
But it's a very minimal. I see it as doing good, really. So it's not a very high fee. If you look at other platforms and what they charge for training, it's much less than that. I see it as goodwill.
Okay. And then another one for Abe. What time charts do you scan in your strategy?
What kind of charts?
What
Usually
what time charts?
oh, time charts. I look at 1-minute charts, 5-minute charts. When I draw my resistance lines, I look at daily charts, usually. If I'm looking for a breakout or I'm trying to figure out what a swing trade might be, I use daily charts. But when I'm trading live, I go for the 1-minute, the 5-minute, and sometimes the 30-minute, but mostly 1 and 5.
Okay. And then you talked about some kind of plug-in or app that you use that you can buy within the trading app. Can you please reiterate that plug-in?
Talked about a lot.
I believe it's, so the question just says trading app to get insight on trading. So I'm guessing it's the pre-market scanner that you talked about.
I use TradingView to chart my trades. It's tradingview.com. I'll go to that slide here real quick. Yes, there's a quicker way to do this, but I'm lazy. Oh, well, I might as well do the quicker way. Where I talk about technology, that slide.
Yes.
I'll leave that up. But I usually, TAS for an entry-level trader is not worth it just because of the cost. But definitely TradingView would be a good buy. I use FinViz as well to scan the markets. FinViz for the most part is free unless you're trying to look for real-time trades. But finviz.com is available to look at top gainers, top losers. Benzinga Pro is for pros trading, so I wouldn't get into that right away. I would hold off till you're somewhat profitable and you're taking riskier trades.
Okay. Another question for you, Abe. How do you decide when to enter a trade using market or limit prices?
In pre-market, I always limit in. You really can't market in pre-market. You'll be screwed, even if your broker allows you. So in pre-market, I always limit in. During the market day, if there's a lot of momentum, so there's a lot of volume that comes into a stock, and I know that my limit price won't get me into a trade, and my risk management strategy tells me I will still be profitable even if I get in and I don't get my exact price and I'm like 10 cents off or 20 cents off, I'll probably market into that trade. And the moment I get profitable, I always use a trailing stop. And the moment I get in a trade, the first thing I do is I set a stop loss.
Okay. Actually, just for the beginners, because like we did the poll, 63% of people are very, very beginner, basic level knowledge of the stock market. So could you just explain the difference between market and limit prices, just for the...
Sure. I'll pull a map here. One moment. There, this is a good chart. So if you go to stock exchange, you get a bit of information. So usually there are different types of entries into a stock. Say a stock is currently trading, let's see, say a stock is currently trading over at, it's currently trading over here, right where my cursor is. And I want to get in on this trade. If I know what my bounce point is, what that resistance point is, I'm probably going to go maybe 5 cents, a little above that limit, and I'm going to set that as my limit buy, which means as the stock price keeps dropping, the moment it hits my limit, it's going to trigger a market buy. Sometimes it's a market limit, so you set an exact point. So when you set that stop buy, it's going to, or limit buy, it's going to buy that stock at that price, which is your entry. And then the moment I'm in, I set what is called a stop loss. So a stop loss is, say that stock on its way down didn't turn and it kept going down. then the moment, say I bought in at this price over here, the moment it reaches my stop loss sell, my broker knows that I already set the stop loss, so it'll get me out of that trade at that price right away. Now, obviously, you could set it as a stop loss limit or a stop loss market. So if you set a limit, what happens is at that trigger price, it's going to say, well, it's past your trigger price, and we should make a decision to sell. But then they're going to start waiting for you for that price to come. And if the stock never hits your price, then you may never sell, and you might still keep bleeding. So usually a better way to do on very volatile stocks is to stop, limit, and then sell, or you have a trigger for a stop loss and then you mark it out. But if you're comfortable and it's a decent stock, you can use a limit, because when it gets there, it'll sell your stock. And then there's also the trailing limit. So say a stock is profitable, I buy in here, I start seeing some movement. No stock ever goes up like that unless it's being pumped. There's usually, it goes up a bit, it pulls back a bit, it goes up a bit, it pulls back a bit to get to that price. And that's where I would usually set my ascending triangle. If a stock is on its way up, usually the moment I get profitable, I set what's called a trailing limit. What that means is, say it goes up to this price. If at this price, it starts turning, it's immediately going to trigger. So if I have a delta of, say, $2, if this stock drops $2, sell. I would either say sell at market or sell at limit. So on its way down from that, say it goes $2, and this was $2, immediately it hits my trigger. My broker is going to know that I'm saying I'm not comfortable taking more than this in a loss, so it's going to go ahead and sell for me. So I use trailing limit or trailing market depending on how volatile the stocks are, and I limit buy. And usually I market sell on very volatile stocks. Hopefully that answers it.
Yeah, that makes sense. Okay, so this question is for both Dolapo and Abe. So if you buy some stocks, for example, 10 shares per unit, and you see the market is starting to do bad, and you want to get out before it gets really bad, would you recommend selling all your units or just some units, especially if the market is generally a good one and you know things would get back? Dolapo, do you want to jump on that?
Yeah,
I have some thoughts on it, but go ahead.
yeah, I can talk about that a little. So there's something I do both when buying and selling my stocks, especially when there's something going on, some exogenous shock that has nothing to do with the company itself. If the market is going bad, like this coronavirus crisis, what me and what a lot of my friends do is we sell like 2 stocks the first day, keeps going bad. The second day we sell 3, the next day we sell 4. So that's just something we do just because it's easier psychologically than just selling all of it at once. And likewise, when the market starts to recover, the first time it might recover today, let me buy like 3 stocks. And then the next time, let me buy 5. And then 3 days after, let me buy 10. So I generally don't buy or sell all at the same time when there's something going on in the market. I see do crumbles here and there, and I start increasing or decreasing the number as time goes on. And it's just my preference and the way my friends do it as well. So it's really up to you, but that's how I do it.
Okay, Abraham?
I sell based off of technical analysis, and I buy based off of technical analysis. I'll show you that chart I had up before. I think we've used it. We've overflogged this stock. If a stock is selling off, my opinion usually is I look for the next line of resistance. So this stock was over at 24.80 cents, and it's going down. I know the next line of resistance is either the moving average or it's 23.07. What I would do at that price, I'll sell everything and I immediately set a buy to buy at the next line of resistance. From a technical analysis standpoint, unless there is an issue or there's a news release, for example, unless there's a different catalyst from the existing market structure, which I'm also watching for, I don't hold on to any losing stock. I dump all my losing stock And again, this is because I'm not a fundamentals trader. I'm not holding on. I don't believe in Facebook. I don't believe in any stock. Sometimes I don't even know what they do. So the moment it starts turning, I'm out of there. And I wait for a good entry price and I get back in. If it's profitable, I sell. If it's not, I get out of there again.
Okay,
All
so
of it.
it's really just between being as technical as you are, Abe, versus being a fundamentalist trader then.
Correct.
Yeah. Okay. So next question here, I guess as a segue to that is, have you both lost money before, and how did you handle the loss psychologically?
Loss is painful. I like being right. Most people who know me know I like being right. And that was one of the adjustments I had to make earlier on getting into the market. A bit of a history of how I started trading. I overheard a bunch of my coworkers talking about a stock. It was Tinley. And I'd been trading kind of before, but not so quite actively. And Tinley was doing good, so I jumped into Tinley, and I almost doubled my account when I first got into Tinley. So I was profitable. I sold, doubled my account. So at this point, I grew this false level of confidence. It's pseudo confidence. I'm like, I'm the stock sensei. And then I was profitable again and again. And I got this false sense of confidence. And then I took my first loss, and it was painful. It was like maybe a whole week of just studying the markets, trying to understand why I lost. And then I took another loss. And my ego took a bit of a hit. So I had to do a lot of reading and a lot of studying and a lot of just watching the markets to build my confidence, kind of some kind of an ego push-up to get my trading muscles right back in there and grow my confidence. So sometimes you don't have to be right is what you always have to remember. The market will always be there the next day. If you're not right today, you will be right another day. And as long as you keep your losses small and your wins high, you will be profitable.
Okay. Dolapo, do you have any insights to that?
Yeah, I think the same goes here. As I said, I'm a fundamental trader, but I have dabbled here and there into trading in specifically options as opposed to ETFs. And I've had days that I've lost $1,000, and I've had days that I've gained like 1,500. So the first time hurts a lot, but I think as you go on, you get to take it as part of the game or part of the business, and you kind of start getting immune to the losses and just think of it as just one of those things that happens. But it goes back to what I said: don't invest your rent money. Don't invest money that you need anytime soon. Just make sure it's disposable income. Make sure it's stuff that you can lose and you can still continue with your daily activities.
Okay. Another one for both of you. I guess this is more for A, but what is your opinion on buying at first rise and selling at first drop?
Unless I was in early enough. If I'm not in before the pop, I don't chase. I don't chase any stocks because any stock that rises fast will fall really fast. So I'm going to show you an example again here. Usually one of the things I do when I review a 5-year history of a stock, or the stock probably doesn't have that, say a 6-month history, is I look for long wicks. If I see a stock like this that opened there and dumped all the way, or I see a stock that a good example, right there, that's a perfect example. So you have a stock, actually I give you an even better example, BPTH. This is a stock I made a killing on, but I was very careful when I played the stock. I don't know if you can see all these longer wicks. What this means is it hit that high of day price of $9.44, and by the end of the day, it was $7. If you go to a 6-month history of BPTH, look at this day. I actually traded this day. If you looked at my Excel, you may have caught it. But I traded this stock. Look at this stock. Opens at $9.98, makes its way all the way to $15. So you could potentially double your account if you keep following the stock at that price. But I don't chase. If I'm not in early, I'm not going to chase. I'll wait for the stock to pull back, because if you go to that day, take your time later on and go to the 21st of November 2019 and look at BPTH, that's the ticker, and just look at the minute chart or even the hour chart. You will see the stock, it went up really fast. It was not progressive. So any stock that grows that fast will also drop that fast. So I don't get in if it's taking a morning pop. I wait for the first pullback. Is it going to hold? I get in. Or the second pullback. Is it going to hold? If it doesn't hold after the second pullback, I'm not going to look at it. I'm going to find the top gainer of the morning and find the pullback to get in on. That's how I trade.
Yeah, and I'll agree with him. There are people, the financial world is really fast. People react in instants. And if I'm the guy that's sitting at my work desk and I see the news that, oh, Tesla just released this amazing thing, and I go to Robinhood and I start to buy Tesla, even before that news article was written and it was sent out, all the big bulls in the market have already bought that and made it overvalued. So by the time I open my app and I decide to buy, that price is already skyrocketed to more than its value, and it's probably going to go down from there. So I'm not that guy that's going to make profit off of stuff just changing in the market. There are people who are sitting at their computers all day in the middle of New York with their high-speed internet that have bought it and made it overpriced 20 minutes before I even found that news. So I don't trade on news because I know that it's risen fast and it's only going to drop fast. But
so to that person, if you're looking to get in on stocks by news, wake up early. Be up at 4, 5, worst case scenario, and watch for news. The first round of news, usually New York time, is released around 8 o'clock. That's 6 o'clock Calgary time. So if you don't catch the first wave of news, you probably won't be in if this is going to be a supernova stock. If it's going to be a top gapper, you won't catch it. You'll have to wait for a pullback. So what I do is I trade on news early in the morning, really early in the morning, right as the news comes out.
Okay.
Then you can get a good entry.
Another question here. What's the best way to go about finding worthy IPOs to investing? So this is more for IPO investing.
FinViz. FinViz has a listing of all IPOs. You can track them. You can look at IPO stocks. You can also, there are lots of tools out there. You can also go, Yahoo Finance has an IPO search as well. So if you go in there, I teach that in my course too.
And can you actually invest in the IPOs with from these tools, or is this just informational?
Yes, it's more informational. You'll have to go trade on Yahoo Finance has it, exchange websites, Google News. There's actually a dedicated website. Sorry, where's my camera? There's a dedicated website. It's called IPO Monitor. There's also IPO Scoop. If you type that in Google, you'll probably find this. You can see all the IPOs that are getting ready to be released, and you can search based on the timeline, and you can get in. There's something else to watch out for beyond IPOs, reverse splits. So what a reverse split is usually you see a stock that's in the New York or in the NASDAQ. There are usually requirements, like reporting requirements. One of the requirements to stay on the NASDAQ is hold a price, or on the New York is hold a price that's above $1. So if a stock was above $1 and it couldn't substantially hold that price, it will be at risk of getting delisted. So if you want to go research, this is another key word of delisting of stocks, as well as stock splits. So usually there's a reverse split. Sometimes there's a 1 to 15 split. So say a stock that you bought at $5 and you weren't watching, and now it's like 20 cents, and they're asked to delist, you will actually stop seeing that stock on the NASDAQ or on the New York, and you're wondering what's happened. Did they steal my money? No, they didn't. They just delisted. They're going to send you a check and say, yeah, we're liquidating all our assets. Or sometimes they don't, even if they don't have any assets to liquidate. So usually what happens with those type of stocks is, in order to maintain their place in the New York, they're going to do a reverse stock split, which means they're going to multiply their stock price by a certain ratio. So a 20-cent stock multiplied by 10. So if they do a 1 to 10 split, for example, could be worth $2. So you wake up in the morning and you look at the stock and you're like, holy shit, sorry, I swore again. And you go, oh, wow, my stock is at $2. I've made a lot of profit. But then when you go into your trading account to your broker, you see that say you had 10 shares and now you only have 1 share. What has happened there is there's been a reverse split. So you should be watching out for that. The good thing with reverse splits is if you're tracking them, and I usually go and track reverse splits, is there are a lot of people who are watching that stock and hoping to buy. So most of these rookie traders, they don't know that there's been a reverse split, and they see a stock go from 20 cents to $2 in a day, and they're like, oh, wow, there must be news coming out. These guys are good. The stock is doing good. And then they buy in at $2, not realizing that stock is still at 20 cents. It's only been reverse split to stay on that, on the New York.
Oh, I think we lost him there. Okay, so I guess we can just go on with the questions here. We have one about what are your thoughts on leveraged investing?
He probably does that. I don't do that as much because I use my own money. Yeah, if you're day trading, you actually you almost definitely need to leverage. If you're a day trader, you almost need to leverage. But as just a general stock trader, I don't leverage my stocks. I just use my own money. So he can probably talk more about it when he comes back online.
Okay, I will ask him again. What else do we have here? Okay, so I think this is more for you, Dolapo. Wait, sorry, that's already been. Okay, so for fundamental investors, what are some other tools, if you're not spending all the time, as a technical investor, going through the candlesticks and all the tickers and all that stuff, what are some other tools that you've used, some practical tools that you've used as a fundamental investor to determine what stocks you want to pick?
Well, I use the news. I use stock tweets. So as much as there are people who talk about what's going to happen in like 5 minutes on stock tweets, there are people who talk about what's going to happen in a year. So you just get people's sentiments. So I use stock tweets as well. I use TradingView, which is what he used to look at the charts. So even though I'm all about the fundamentals, I still look at the charts to see where they're at, if they're kind of undervalued at this point, and see trajectory. So I use stock tweets as well. Investopedia, as I said, I use that to just learn about what certain things mean. And the financial, the K10 or 10K, the annual reports from the companies. So I try to always read the annual reports from the companies. Scan over all the gibberish, but look at the numbers. Are their numbers growing? Are their numbers projected to grow? What are they doing different? Are they trying to, are they forecasting a lot of new customers, a lot of new products? So it's basically reading the business, learning more about the business, and deciding if you believe it, for me. So I don't use as much tools as probably he does for the technical stuff. I just read to understand, and when I understand, I can make my decision.
Okay.
Sorry, guys, I had to take a very important call, so it logged me off of Zoom on my phone, but I'm back on now on my computer.
That's fine. There was a question here about leveraged investing and what your thoughts are on that.
I love leveraging. I trade most of my leverage investments are like the TVIX, like inverse ETFs. Usually the good thing about leverage investments is, say the SPY, for example, which is SPDR 500. If the SPY is doing really well, some inverse ETFs will do bad. If the SPY is doing bad, like it's doing bad right now, I actually got into just not as much stocks as I should have, because I was planning for November, hoping Bernie would win in the US and there'd be a market crash. But I was watching TVIX for the longest time, and it was at $40 in February when I bought in. It went to over $1,000 in the last month. And the reason for that is it's a leveraged equity. And what that means, or it's a leveraged fund, what that means is if the SPY goes up really fast, the TVI, or even slow, the TVIX will deplete in its stock price really fast. If the SPY goes down slow, the TVX goes up really fast. So you have like 2 times leveraged stocks, you have 3 times, 4 times leveraged stocks, and usually ETFs are designed to go to 0 or really close to 0. So what happens is the faster the market that fund or leverage fund is moving, the slower or the faster that your leverage fund is doing. So they're good investments. I like them as long as you know what you're doing and you understand that there's a huge decay in leverage stocks.
Okay. Another question for Abe. Are there volume criteria in terms of numbers that you use before entering a trade or regardless of price action? So do you look at volume?
You can't see my video, but I'm laughing because that's in my course, and maybe that's okay. I'll give the information. Usually, I'll put my scanner up here. All right, I'll give that away. Usually what I look for is I look for pre-market change, but if you notice, let's go Abe quick wins here. The moment that loads, you'll see that I'm looking for relative volume. So what relative volume is, it's this stock, for example, usually has a volume of 4.82 million. But today it has 3 times as much volume as it usually has. That tells me there'll be volatility. So I look, relative volume is, I don't even care as much about average volume, but I still look at it. I look at stocks that are between 500,000 to greater than 5 million in average volume. But for relative volume, I'm usually looking for greater than 1. So if there's more volume in the stock than there typically is, it's probably going to move. So that's what I look at. But volume does not mean price action. There may be a lot of volume in the stock, but it's selling volume and it's going in the opposite direction. So you also have to use that with other indicators. And I also look at change percent. So usually if a stock is doing above 2% in pre-market, I probably would consider it because I know that I might be one of the earliest retail traders to get in on that stock. So if I catch it early, most likely I might play it and see what comes of it if there's decent history.
Okay. Another one here is, if you're an investor in mutual funds, will you hold or sell in the current state of the market? I think this is for both Dolapo and Abe.
I can't advise on the markets.
Yeah, it's all up to you, because one of the uncertainties is whenever something like this happens, no one knows when it's going to be at its worst, right? You decide to put in today. What if today's the worst and it starts going up from tomorrow? You decide to stay in today. Who knows if it's going to get 5 times worse? So I don't know. That's why I stagger my purchases. So I bought some stocks last week. It might be the lowest it might have been the lowest last week and it's going up from now. I don't know. But next week I plan to buy, a couple more stocks. And the week after I plan to buy even more. So I keep buying that. So with that pattern, at some point I'm going to have bought at the lowest and it's going to go up from there. But I never know which is the lowest. I don't know if it's past the lowest. I don't know if it's going to be lowest next week. I don't know if it's going to be lowest 2 weeks later. So it's all up to you.
Okay. I think that's everything for now. There are no questions coming in anymore. Thank you guys so much. We're way past our time. Thank you to everyone for actually dialing in. I hope you learned at least some stuff that can help you get started in the stock market. I guess for Dolapo, can you just give us maybe the top 3 things for someone who joined this call as a very, very basic beginner, and what you think they should do to start trading on Monday? What are your top 3 tips for them?
Well, again, as I said, investing in the stock market isn't as high risk as day trading. So I think you should just buy a stock. Just buy anything. Any stock that you like, and get your hands dirty and just get in there and you might lose some money. You're like, whoa, okay, now let me learn what I did wrong. So you get in there, you might lose $5, you might lose $2, but I feel like we can all withstand losing $2. But get in there, get your hands dirty, and learn from there. Which definitely you shouldn't do in day trading. You should learn as much paper trade before you actually get in there. But as I had said, I just bought a stock, and that got me like, ooh, I made $2. How do I make even more? So get in there, buy a stock and see how that goes, and just read as much as you can, and watch my YouTube channel. I'm about to upload a video today, so you guys go like and subscribe. I'm going to be having a lot of great content. But yeah.
Awesome. Okay, thank you. And like we said, this was brought to you by Inside Your Finance on Instagram. So feel free to follow our page if you want to get more, information or just more events like this. We'll definitely be doing more. I know Abe's session was a bit it was very technical and very advanced. So we'll probably have various other sessions sort of like that for people to continue with their trades and learn more. So thank you for coming, and sorry that we're 45 minutes past the time that we were supposed to end. We apologize for that, and we hope to see you at the next event. Thanks, guys.
Yeah, thanks, you guys.